Chapter 14, Partnership Tax. Learning Objective 1, Partnership Formation. Now, when a group of individuals join together in a business venture and form a partnership, this is typically done by contributing something of value to the business venture. It can be cash or property as typical examples. In that contribution to the venture, typically the partner is not going to recognize any gain or loss in that formation, but we're going to have a basis calculation. And with respect to a partnership, we're going to keep track of two different kinds of bases. We're going to have first what is called outside basis, and that's going to be the partner's share of the partnership. It will have a basis in it, and that will come into play if the partner, for example, were to sell their share in the partnership, or if they are receiving distributions. The second basis we're going to take a look at is what's referred to as inside basis, and that is going to be what the basis of the property held by the partnership is going to be. And usually our inside basis is going to equal our outside basis, and that's done by that contribution. So if we had $10,000 in cash, for example, it would have a $10,000 basis. If the first partner contributes that to the joint venture, to the partnership, they would then have that same 10,000 basis in their partnership interest, and the partnership holding 10,000 cash would have a 10,000 basis in it. Similarly, if the other partner in this situation were to have a piece of property with an $8,000 basis but a $10,000 fair market value, they contribute the property. They have an $8,000 basis in the property. They would typically have an $8,000 outside basis then in their partnership, and the partnership itself would still hold that $8,000 basis in the property despite it having a fair market value of $10,000. This is what we call basis in, basis out, that being that the beginning basis to the partnership is going to be the basis of the contributed assets, and the partnership is going to step into the shoes. So the basis of the assets in the hand of the partnership will typically be the same as it was on the outside. So we're not going to have gain recognition on the contribution itself. In the property example, the $8,000 basis, the partnership will step into the shoes of the partner that previously held it and still retain that $8,000 basis in that property. A holding period of these assets, if we're talking about ordinary assets, the holding period is going to begin on the date of the contribution, so we're just going to start fresh upon contribution. But if we're talking about a 1231 asset or a capital asset, we're going to retain that holding period. So whatever the partner's holding period, if they held it as a long-term asset, the partnership is going to be able to keep that long-term asset holding period. Now, contributing cash or contributing property are typical ways to form a partnership to engage in this joint business venture. But another way that a partner might contribute to the formation of a partnership is going to be kind of what you'd maybe refer to as sweat equity, but they're going to work. They're going to provide some contribution of services instead of cash or property that's going to help the partnership form or help the partnership in the long term, but they're not actually going to contribute anything. So in our example before, where we had one partner contributing $10,000 in cash, we had another partner contributing $10,000 in property. We may have a third partner here that is going to go and perform work, and in exchange, they might receive, say, a 33% interest in the partnership. So all three of our partners are going to be equal partners. Here, the partner providing the service is going to recognize ordinary income. So we've got $10,000 that is going to be for the cash, $10,000 piece of property. So we've got $20,000 of value sitting in our partnership. And to get a 33 or a third percent interest in that partnership, we would divide the 20,000 by 3. So we'd have $6,667 that would be recognized as a gain by the sweat equity partner here, the one that's contributing services. Additionally, you might have assumption of liabilities by the partnership. So in our example where we're kind of showcasing the different ways we can form the partnership, we didn't talk about any liabilities that might have attached to that $10,000 piece of property. If there was a liability on it, and in furtherance of this contribution, the partner was going to be released from liability but the partnership itself would be assuming it and taking over the liability. The release of the liability would be treated as a money distribution to the partner. So that's going to reduce their basis in doing so. So for example, if we had an $8,000 piece of property, fair market value of $10,000, but it had a $2,000 liability associated with it, and that was going to be taken over by the partnership itself. The partner would still have a third exposure to it, but 2/3 of that $2,000 would not be. So we would have of that, we would have $667 for the partner that would still have exposure, and we'd have $1,333 of the liabilities that were being relieved of the partner's individual responsibility, but taken over and assumed by the partnership. So that $1,333 would reduce the $8,000 basis that the partner has. So they would then have a $6,667 basis in the partnership interest. So let's take a look at our first concept check here for learning objective 1. We say generally a partner does not recognize a gain on the formation of a partnership. That's going to be true. Concept check 2, typically the basis of the asset contributed to a partnership is the same in the hands of the partnership as it was in the hands of the contributing partner. That is going to be true as well. So basis in, basis out, and the partnership is stepping into the shoes of the partner for that basis. Concept check 3, if two taxpayers form a partnership and each has a 50% interest in it, each partner's outside basis must be equal. And that's going to be false. In our example before, where we had $10,000 contributed in cash by one partner and a $10,000 piece of property contributed by the other partner, the basis would be $10,000 for partner 1 and $8,000 for partner 2. So those would be separate bases. So it does not have to be equal upon formation. So concept check 4, a partner does not have to recognize a gain on the receipt of partnership interest in exchange for services. That's going to be false. If you're providing services in your formation, and that's going to be your contribution to the business venture, you're going to recognize the gain for the value of that services based on the fair market value that partnership is going to have and the share of the partnership that you're receiving in exchange for it. Concept check 5, a partner who assumes an increased portion of the partnership debt is treated as making a cash contribution, and his or her basis in the partnership increases. So that is going to be true. So similarly in the example when we talked about the assumption of liabilities, where the individual that previously had the individual liability that's being assumed by the partnership, whereas their basis decreases by the $1,333, $667 would be a basis increase for the other partners that are involved in that business venture and that partnership. And the reason why is similarly how the partner that is having the liability assumed is going to receive a benefit there. The partners that are did not previously have the liability, but the partnership is taking it over, then receiving the burden of that liability. So that's going to go into their basis. Learning objective 2, partnership ordinary income or loss. So the ordinary income that a partnership receives is going to be based on what you typically think of in a business venture. So we're going to have sales or revenue from service, and we're going to have ordinary necessary expenses that are included in that venture. So that's a characterization of this income or loss that we've typically seen before. And we're not going to have anything that's included in this that's treated differently at each partner level. And that's going to be considered separately stated items, and we'll take a look at that later in this lecture in terms of how and why that is going to be set aside and set separately. So one thing that is a little bit different in the partnership here is we're going to have something called guaranteed payments. And the reason why these payments are going to be made to partners, or if they are payments made to partners, The partners are owners in the venture, so they are not going to be salaried workers. So we are not going to, they're not going to be employees, we're not going to pay them a salary, but if we are agreeing to pay them a set amount on a monthly basis, for example, we're going to list that payment separately as the guaranteed payment, and we're going to calculate that without regard to the partnership income. So it's going to be a separate calculation that we're making there for those partners. Additionally, depreciation is going to follow the same rules as sole proprietorship, and the Section 179 expenses are going to be separately stated, and we'll go into why that is in a little bit, but generally what it is each partner may have a different situation with respect to Section 179 property, or excuse me, Section 179 depreciation on their property. So we want to list it separately, that way each partner, once they receive their K1, can address it on an individual basis. Partner health premiums are also going to be a little bit different, as we're not salary worker here. We're not going to exclude from income health insurance premiums that are paid to the partners, but what we can do is treat those premiums as guaranteed payments. And that's typically what a partnership would do. So let's look at our concept check for learning objective 2. Partnership can deduct which of the following in determining partnership ordinary income or loss? All ordinary and necessary expenses, guaranteed payments, depreciation, or D, all of the above? And the answer is going to be D, all of the above. 2, what tax form is the partnership required to file each year? 1120, 1040, 1065, or 1120S? And the answer here is going to be our 1065. Payment made to a partner that is calculated without regard to partnership income. We've got partner salary, partner withdrawal, partner loan, or guaranteed payment, and that's going to be the guaranteed payment. So learning objective 3 is going to be those separately stated items, and the general is all income and expenses that may be treated differently at the partner level are going to be separately stated. Some examples of those are going to be rental income, interest and dividend income, capital gains, and that Section 179 expense for depreciation we previously looked at. And the issues that might come into play here is partners may be differently situated for passive activity and at risk. They may be differently situated in terms of which tax rates are going to apply to dividend income or capital gains income, for example. They may also have other partnerships or other business ventures on which they're taking Section 179 expenses for depreciation, so they may reach a limit faster or than other partners. So there may be some variety there. So we want to state those items separately. That way, whatever the individual tax situation is for the partner, they will have those items broken out so they could organize them as their situation requires. And we're going to report that to them on something called a K1. So that's going to report the share of ordinary income. It's also going to report those separately stated items for each partner. And then the line items on that K1 are going to correspond to the Schedule K on the Form 1065, on that informational return that a partnership is going to file. And since the partners are not going to be the employees, again, they're not receiving salary, but they are receiving these guaranteed payments. And what we're going to do for the other income that's being received, the ordinary income, and then including those guaranteed payments, is going to be considered essentially self-employment income. So the way we're going to calculate that is we'll take the ordinary income as our starting point, and that's going to be line 1 on the K1. We're going to add any of those guaranteed payments from line 4, and then we're going to subtract ordinary gain that was included in ordinary income. And then we're also going to subtract the 179 expense from line 12. So let's take a look at the concept check here. So why are items such as rental income loss, capital gain loss, and charitable contributions that flow through a partnership treated as separately stated? And the reason is that each partner might not be similarly situated with respect to those items. So we talked about the 4 examples from the previous slide, talking about different rates that might apply, for example, to the capital gains or to the dividend income that is received. But we may also have something up to, for example, a capital loss that we're going to want to count against ordinary income. And that's something that individual partners may be able to do, and their situation may permit them to do that. However, it's not individuals that are the only ones permitted to be partners. We can also have corporate partners that will hold partnership interest. And if you have a corporate partner in the same partnership as the individual partners, they cannot use this. So that's also going to be a difference between partners in that situation. So this is why we're going to have those items as separately stated. So it has basically taking a look at each of those items and whether the tax treatment can be different based on different situations. And if it is, then we're just going to want to treat it as separate. That way each partner can address it as their situation requires, whether that partner is an individual or a corporation, and with respect to the partner's individual tax situation. So concept check 2 here, why is income from a partnership treated as self-employment income? And the reason why is they're not employees. So whereas in a general salaried situation, we might have the FICA taxes taken out, withheld from that income, and paid off to either Social Security or Medicare. Here, the income received by the partner from the partnership is not going to withhold any Social Security or Medicare from it. This is just going to be income that's earned through the business venture, through the partnership, and then the partner's share of that. So let's take a look in learning objective 4 here, the basis of the partnership interest and how we're going to calculate that outside basis. So as we go through, the outside basis that a partner has is going to change. And we're going to start out in the formation of the basis of the property contributed. So that's going to be typically the starting point for a partner. We're going to add the fair market value of services rendered, where cost of the partnership interest was purchased. We're going to add the basis of cash or property contributions after formation. So the property contributed at formation, we're going to count as our initial outside basis calculation. But if later we also make a contribution to the partnership, we're going to get that as an increase in the basis. We're also going to take the share of partnership ordinary income to increase the basis. So we're going to report that through the K1 is going to get reported to us for our share of the ordinary income if we're the partner. And then we're going to have to translate that over to the 1040 to report that as our share of ordinary income. However, where that is going to come into play with respect to the partnership interest itself is that it'll be an increase in the basis that we have, which once we either take distributions, whether liquidating or non-liquidating, or if we end up selling our interest, that basis is going to come into play. So we're also going to increase the share of separately stated income and gain items, and then the share in partnership liabilities. We're going to subtract out, however, the basis of cash or property distributed, and that's going to be capped at 0. So we can never have a negative basis in our partnership interest. We're also going to subtract out the share of the partnership's ordinary losses. And again, that's going to be capped at 0, so we can never have negative basis in that partnership interest. We're also going to subtract out a release of partnership liabilities to where, same way if the partnership assumes liability from another partner, we might get an increase in basis. If it's assuming the liability we had over the property, that's going to decrease our basis. And we'll also subtract the share of separately stated losses and expenses, similar to how we would subtract the share of partner ordinary losses. Let's take a look at the concept check here. A partner must use basis to determine the gain or loss on a sale of the partnership interest and whether the losses are deductible. That's going to be true. 2, partner's basis is not increased by his or her share of tax-exempt income. That is going to be false. So if partner's basis is going to be increased by those income items, by those gain items, irrespective of whether it's tax exempt or not. Three, In the calculation of basis, the order of the basis adjustments is not important, and that's going to be false. We're going to follow the order in terms of doing that calculation for those basis adjustments. For a partner's basis never increased by his or her share of recourse liabilities, and that's going to be false. If a partner does have recourse liabilities meaning that they have personal liability associated with that, that's going to increase their basis in the partnership interest. Learning objective 5, partnership distributions. So first, taking a look at non-liquidating distributions. So this is typically ongoing in the partnership's existence and in the business venture's existence. Partners typically going to recognize no gain or loss. We're recognizing the gain based on the income that the partnership receives, and then we will make a basis adjustment on that. If we have a non-liquidating distribution, that will similarly be a basis adjustment, but itself will not be something that triggers a recognition in gain or loss. Gain will be recognized if money or marketable securities are distributed in excess of partner's basis. And look here at the two prongs that we have. The first is going to be whether money and marketable securities are involved, so not property. And then the second is going to be it has to be in excess of the partner's basis. So if it has to be, we can take the basis up until the point until we hit 0, but we cannot go negative for the basis, so we would recognize gain. We also are going to recognize gain for current distributions that trigger a pre-contribution gain. So what is a pre-contribution gain? So that's going to be when a partner contributes appreciated property to the partnership, and then the partnership immediately, or at least within 7 years, distributes the same property to another partner. So this is kind of like washing the property through the partnership. It is, in effect, a sale of the property from, or a transfer of the property from one partner to the other partner. On the basis of the distributed property, typically the partner would step into the shoes of the partnership. And that's going to be for the general rule for basis of distributed property, to where if, similar to how if we had a cash distribution, the basis would get retained. If we have a property distribution to where we had the $10,000 fair market value, $8,000 basis, we distribute that basis to one of the partners. Then the partner is then going to have an $8,000 basis in that $10,000 fair market value property. Let's take a look at our concept check here. Which of the following is true concerning recognition of gain on a distribution from a partnership? We've got our choices here. And the answer is going to be B. The gain is recognized if the partner receives cash in excess of his or her basis. And that is going to be what's going to trigger a recognition of the gain or distribution from the partner. So again, we need two things. We need either cash or security. And we have it here by receiving cash. And it also has to be in excess of the basis. So if it's not in excess of the basis, we can run that calculation and decrease basis by the amount of the distribution. So Nelson, concept check 2. Nelson has a partnership basis of $12,000, receives from the partnership a distribution of furniture with a basis in the partnership of $16,000 and a fair market value of $10,000. Nelson's basis in the furniture after distribution from the partnership. So here, the basis would be $12,000. So we've got a partnership basis of $12,000. The furniture has a basis of $16,000, but a fair market value of $10,000. We typically step into the shoes and take that $16,000 basis in the hands of the partner. However, we only have $12,000 in the actual partnership interest itself. We can't go negative, so we'd only have $12,000 for the basis in that property. And then that would leave us with 0 basis in the partnership interest. So concept check 3. Assume the same. However, if we receive the cash distribution of $4,000 with the furniture, then the basis of the furniture after the distribution. So here we started with a $12,000 basis in interest. We received a cash distribution of $4,000, so it's going to leave us with an $8,000 basis in the property interest prior to the distribution of property. So here we would take that $8,000, leaving us with the zero basis in the partnership interest. So we'd have an $8,000 basis and a $10,000 fair market value property. So learning objective 6, disposal or liquidation of the partnership interest. Liquidation, the rules are going to be similar to those current distributions. And again, the distribution of money in excess of basis is going to cause a capital gain. Here, a loss can be recognized if the amount received is in liquidation is going to be less than the partner's outside basis, and only money, receivables, and or inventory are received. So if we're in liquidation and the distribution is less than the partner's outside basis, and it's only money, receivables, and or inventory that are received. So taking a look at a sale of partnership interest, that's going to be treated generally as a sale of capital asset. However, if there is substantially appreciated inventory or accounts receivable, things that the partnership itself would typically sell off to create an ordinary gain, accounts receivable being pending monies coming in for those ordinary incomes. The character of those would typically be thought of as ordinary income, so some of that capital gain could be categorized as ordinary. And then the individual partners are going to report the sale on Form 1040 for the Schedule D. So let's take a look at the concept check here for learning objective 6. 1, Shelley has a basis in her partnership interest of $30,000. She received the following assets in complete liquidation of the partnership interest. We want to know what is Shelley's recognized gain. And we also want to know what is the basis in each of the assets distributed. So here we have received liquidation distribution of assets that are going to be $35,000. We had a basis in $30,000. And the recognized gain that we're going to have here is actually going to be 0. And the reason why is we did not receive cash in excess of that basis. We've only received $9,000 in cash and then $15,000 for either cash or inventory. So those are going to reduce the basis that we have in the partnership interest, but are not going to trigger gain recognition. The basis that we have in the assets distributed, we are going to make an adjustment to the equipment and land. Here we had $20,000 basis in the partnership itself, but we've only got $15,000 in basis left. So what we're going to want to do is take that $15,000 and then multiply it by the percent of the $20,000 basis that the partnership held it in to kind of get a pro rata adjustment to the basis being distributed. So here we would take our $8,000 piece of equipment that had a basis in the partnership of $8,000. In our hands in distribution, it would be $6,000. Similarly, land that was $12,000 basis in the hands of the partnership, when distributed, we'll take it as a $9,000 basis. And the reason why is we've got $15,000 basis that we are going to be using for the basis that we'll have in these assets collectively. 60% of that is for the land and 40% of that is for the equipment. So we're going to take 60% of our partnership interest basis and set that to the land. And we're going to take the 40% of our partnership interest basis and set that to the equipment. So we would have 9,000 basis in cash, 6,000 in inventory, which are calculated for the basis and the partnership interest first. So those are going to be the same. And then we're going to have new basis of 6,000 for the equipment in the partner's hands, and new basis of 9,000 for the land in the partner's hands. Concept check 2. We're going to Kelly purchased a 60% interest in it for $55,000 in March 18th. She had income of $18,000 for the partnership in 2018 and $26,000 in 2019. She made no additional contributions to or withdrawals from the partnership. On December 30th, she sold her partnership for $107,000. So we want to know what is her basis before the sale. And what we're going to do here is we're going to have the partnership interest, $55,000 as far as what we purchased. So we're going to have that as our starting point for basis. We are going to have income that's going to add to it of $18,000, and then income in 2019 that's going to add to it of $26,000. So what we're going to do for that is take, so we're going to also look for what the gain or loss is, and is the gain or loss capital or ordinary. But with respect to the first one we're looking at was the basis for the sale. We're going to take $55,000 for the beginning basis. We're going to add $18,000 from the 2018, $26,000 from the 2019. So we're going to have $44,000 in income. That's going to increase the $55,000 beginning basis, leaving us with $99,000 for the basis before the sale. We're going to have proceeds from the sale of the partnership interest of $107,000, less the basis at the time of the sale of $99,000. So we're going to have $8,000 as a gain. And is the gain capital or ordinary? Here it's going to be capital. We might have a portion of it ordinary if we had involved either accounts receivable or appreciated inventory. But without that being listed in the question here, we're assuming that we have a traditional typical sale. So we're going to have capital gain. That's going to be the characterization. And then for the holding period, it's also going to be considered long-term gain.